While the defense secretary was on television this weekend telling the public not to worry about the Strait of Hormuz closure, the United States Treasury Department was doing something completely different behind closed doors. Treasury Secretary Scott Bessent issued an emergency waiver through the Office of Foreign Assets Control, expanded on March 12th from Indian refiners to all global buyers worldwide. The waiver allows global refiners to purchase Russian oil that would otherwise be sanctioned, specifically to prevent the global economy from choking on the Middle East energy blockade. Read that action for what it is, not confidence, damage control at the highest level of the United States government. The energy crisis triggered by this conflict is so severe and the loss of Middle Eastern supply so catastrophic that Washington is quietly dismantling its own sanctions architecture to plug the gap. And the reason that emergency action connects directly to the silver sitting in your portfolio is a number: 86.13 million ounces. That is what COMEX registered silver vaults printed today. 63 days ago, that number was 150 million. More than two-thirds of the deliverable silver supply in the Western world's flagship exchange has physically walked out the door since January. What the OFAC waiver tells you about the energy crisis, the 86.13 million figure tells you about the silver market. Both are damage control signals, one from Washington, one from the vaults. Stay in. Everything builds from here. Let us be precise about the Strait of Hormuz, 21 miles wide. Before this conflict, approximately 20 million barrels of crude oil transited through it every single day. That is roughly 20% of the entire world's daily oil consumption and more than 1/4 of all seaborne oil trade on the planet. Tanker tracking data shows commercial shipping through the strait has plummeted to a near total halt. And the mechanism that makes the closure real rather than theoretical, protection and indemnity insurance clubs cover roughly 90% of the world's ocean-going tonnage. They have revoked war risk coverage for commercial vessels operating in the Persian Gulf. No insurance means no ships. No ships means no oil. Brent crude touched $100 per barrel, highest since 2022. Now here's the connection between $100 oil and the silver in the COMEX vaults, because most analysis treats these as separate stories. They are not. Silver does not materialize on a trading screen. It is blasted from rock, hauled by diesel trucks, crushed, smelted, refined, and shipped across oceans. Every single step of that physical supply chain runs on energy. When crude surges to $100 per barrel, the all-in sustaining cost for mining companies does not creep higher, it skyrockets. A mining operation in Mexico or Peru does not care that an algorithm pushed the paper price lower on a Friday afternoon. They care that their energy input costs just went parabolic. The physical supply chain for newly mined silver is tightening and becoming vastly more costly to operate, at the exact moment paper traders are trying to price the metal lower. That divergence is not sustainable. One side is lying, and it is not the mining costs. Now the macro layer sitting underneath the energy crisis. The United States government just revised fourth quarter 2025 GDP growth down to 0.7%. At the exact same moment, the core PCE price index, the Federal Reserve's preferred inflation gauge, printed hot at 3.1%, slow growth at 0.7%, sticky inflation at 3.1%, stagflation, the single worst scenario for any central banker because it eliminates every clean option simultaneously. The Fed cannot cut rates to rescue the slowing economy. With crude at $100 and inflation already at 3.1%, cutting rates pours gasoline on the fire. But holding rates high or raising them crushes an economy already limping at 0.7%. There is no clean door out of that room. This stagflationary reality caused violent swings in the dollar on Friday. Those swings triggered cascading algorithmic reactions across the paper-silver market. That is what you saw on Friday afternoon. Not fundamentals driving silver lower, machines reacting to dollar volatility on autopilot, but automated selling pressure against a vault system that has just had two-thirds of its deliverable supply drained in 63 days is not a sustainable combination. The paper mechanism is running on borrowed time. To understand the full scale of what is happening physically, you need to see COMEX not as an isolated exchange but as one component of the global liquid silver float. There are three major vault systems that together represent the world's tradable physical silver supply. The LBMA in London, COMEX in New York, the Shanghai Futures Exchange and Shanghai Gold Exchange in Asia. All three are draining simultaneously. The LBMA, which had been building its stockpile, has begun a visible downtick. COMEX has been cratered, and Shanghai, SHFE silver vaults have plummeted to approximately 327 metric tons, the lowest level of deliverable silver in Shanghai since 2015, a near-decade low. 3 vault systems, 3 continents, all moving in the same direction at the same time. Now the verified COMEX delivery sequence. Every number I am about to state comes directly from CME Group's own published vault reports. Verify every figure independently. Entering January, COMEX registered inventory stood at roughly 150 million ounces. January alone, 49.2 million ounces physically delivered out of the vaults. February, another 25.18 million ounces walked out the door. First days of March alone, over 32 million ounces already standing for physical delivery. Tracking at the highest monthly pace in modern exchange history, total drained in 63 days over 102 million ounces against a starting registered inventory of 150 million. More than 2/3 of deliverable supply. 63 days. Now the paper architecture sitting on top of that physical reality. Open interest on COMEX silver futures, the total paper contracts claiming a right to that metal, currently sits at roughly 575 million ounces of exposure. Divide paper claims by actual registered metal. For every single dollar of paper silver trading on the exchange right now, there are only 15 cents of real physical metal in the vault backing it up. The system is leveraged nearly 7-to-1. And here is what makes that 15 cents figure even more acute when read alongside the lease rate data. Monetary Metals is currently offering 12% annualized returns to lease physical silver, partnering with StoneX, a COMEX clearing member operating across 4 continents, to borrow physical silver directly from retail investors. Normal silver lease rates run 1-2% annually. 12% is 6 times the normal rate. When the cost of borrowing physical silver runs at 6 times the historical normal, while the coverage ratio on the exchange delivering it sits at 15 cents on the dollar, those 2 data points are not separate observations. They are the same story told from 2 different angles, and then the CME made the entire situation more acute. On Friday evening, CME Group cut initial margin requirements for silver futures by 22%, dropping the requirement from 18% down to 14%. In a normal, well-supplied market, a margin reduction lets speculative traders buy more paper contracts with less collateral. That is the intended effect. But in a market where physical vaults have delivered out 2/3 of their supply in 63 days, and industrial buyers are standing for delivery at the highest monthly pace in modern exchange history, a margin cut does something completely different. It makes it 22% cheaper for institutional players to build massive long positions and legally demand physical delivery from the exchange. The CME just made it cheaper to drain their own vaults. That is not a defense mechanism. That is an accelerant. Now the Shanghai session, because this is where the paper discount meets physical demand in real time. Chinese industrial buyers, solar panel manufacturers, electric vehicle producers, and defense contractors all track the exact same COMEX vault data. They read the same CME Group reports, and their own domestic vaults are already at near-decade lows. The Shanghai market has been trading in full backwardation, meaning buyers are so desperate for immediate physical delivery that they are paying premiums over future paper prices just to get physical bars right now. That is not bearish behavior, that is panic accumulation. When the Asian session opens, those buyers are going to see SHFE vaults at 10-year lows, crude oil at $100 per barrel, guaranteeing every ounce of future mining production costs dramatically more to extract, the Strait of HORMUZ blockaded, threatening every supply chain that moves physical material by sea, and then they are going to see the Western COMEX price, artificially pushed lower by algorithms over the weekend. They are going to hit the bid on every discounted paper contract they can find. They are going to stand for physical delivery, and they are going to use the West's own paper suppression as a subsidy to drain whatever remains of the 86 million ounces. When paper price drops but physical demand is structural and relentless, the suppression does not work. It accelerates the transfer of hard assets from west to east at a discount. This is not speculation about what might happen. This is the mechanical consequence of 15 cents on the dollar coverage. Meeting the most acute physical demand environment in a decade, at the precise moment the East holds all the physical leverage. The bear case is real and gets full precision. GDP at 0.7% signals genuine economic weakness. In past cycles, slowing growth has crushed commodity demand as industrial consumption contracts alongside the broader economy. If the Fed holds rates or signals further tightening, the dollar strengthens substantially, and a strong dollar historically pressures metals priced in it, independent of any physical market dynamic. There is also the possibility that geopolitical tensions de-escalate faster than expected. If the Strait of Hormuz reopens and oil pulls back from $100, the energy cost floor argument weakens and silver faces legitimate downward pressure from reduced inflation fears simultaneously, and margin calls from Friday's sell-off could force leveraged longs to liquidate at the Monday open, creating a genuine short-term paper flush regardless of what the physical vaults show. Those risks are real. They are not imaginary. Anyone who tells you silver can only go up is not analyzing the market. They are selling you a fantasy. What the physical data, vault math, energy cost structure, global float drain, and Asian demand signals all show is that every structural indicator points in one direction, and that direction is not down. How you navigate what is coming depends on the structure of what you are holding. Physical silver in your own possession. Zero counterparty risk. When the paper price gets suppressed, your ounce count does not change. What you will see over the coming days is physical dealer premiums expanding significantly. The spot price might read $85, but attempting to purchase a physical coin right now means paying 20% to 30% above that number. Dealers raise premiums because they cannot replace inventory at the artificial paper price. Your wealth is insulated by that physical friction. PSLV, the Sprott Physical Silver Trust. Fully allocated, unencumbered, audited physical silver at the Royal Canadian Mint in Ottawa. No leverage, no derivatives. When the paper price drops, PSLV drops with it because it tracks spot. You will see red on your screen, but the physical backing remains absolute. The exact same ounces backing your shares today will be backing them tomorrow. What you must watch is the premium or discount to net asset value. PSLV has been trading at a slight discount recently. In a true physical delivery crisis, when institutional money realizes COMEX cannot supply the metal, capital rotates heavily into verified physical structures like PSLV. That rotation flips PSLV from discount to significant premium, outperforming spot entirely. Track that premium and discount in real time at cfconnect.com. Do not let a paper price dip shake you out of a fully allocated physical position right before institutions rotate in. SLV, the iShares Silver Trust. Highest structural risk in the vehicle spectrum. SLV is a paper tracking vehicle. Custodian is JP Morgan Chase in London. Retail investors cannot redeem SLV shares for physical silver bars. That right is reserved exclusively for authorized participants. In a COMEX force majeure event, if the exchange is forced to cash settle contracts because registered silver runs out, the paper price disconnects from the physical price entirely. Physical silver surges. SLV sits stranded, tracking a broken index. That is your structural risk. Understand it before the event, not during it. AGQ, the ProShares Ultra Silver ETF, 2x daily leveraged. In a market driven by war headlines and algorithmic whipsaws, AGQ suffers severe volatility decay. Silver up 10% Monday, then down 10% Tuesday. Silver itself is down roughly 1% overall. Your AGQ position goes up 20%, then down 20%, leaving you mathematically down 4%. AGQ destroys capital in choppy conditions. It is a trading instrument, not a safe haven, not this week. Here is exactly what to watch over the next 72 hours. Step 1. Watch crude oil. As long as the Strait of Hormuz remains blockaded and Brent holds at or above $100, the inflationary floor underneath silver mining costs is locked in place. Every day oil sustains at that level is another day the physical cost of producing silver rises further above the paper price. Step 2. Watch the Shanghai silver premium when the Asian session opens. If Chinese buyers are aggressively bidding up the price and paying a premium over Western spot, that is real-time confirmation the East is buying the paper discount and draining global supply. The margin cut has backfired. The transfer is accelerating. Step 3. Watch the PSLV discount to net asset value at the New York Open. Track it in real time at cfconnect.com. If that discount begins narrowing aggressively towards zero, institutional money is rotating directly into allocated physical safety. That is the smart money signal in real time. Step 4. Pull the CME Group Daily Silver Vault Report. Publicly available. Updated every session. If the 86.13 million ounce registered number drops closer to 80 million, the mathematical pressure on the remaining paper short positions becomes suffocating as we move deeper into the active delivery window. Every one of those 4 signals is publicly verifiable. None of them require trusting any analysis, including this channel's. The data is there. Verify it yourself. Here is the complete picture. The United States Treasury issued an emergency OFAC waiver rolling back sanctions on Russian oil because the energy blockade is severe enough to require damage control at the highest level of government. COMEX registered silver at 86.13 million ounces, down from 150 million in 63 days. 102 million ounces physically delivered out in that window. 575 million ounces of paper exposure against 86 million of real metal. 15 cents on the dollar, 7-to-1 leverage. SHFE vaults at a near-decade low. Shanghai and backwardation. Monetary metals paying 12% to borrow physical silver when normal is 1 to 2%. The CME cut margin requirements by 22%, making it cheaper to drain their own vaults. GDP at 0.7%. PCE at 3.1%. Stagflation confirmed. Fed trapped. 3 vault systems across 3 continents draining simultaneously. Tonight, when the Asian session opens, buyers sitting on near-decade-low domestic inventories are going to see a discounted Western paper price, and they are going to use it as a subsidy to drain whatever remains of those 86 million ounces. The paper suppression is not containing the physical reality, it is funding the transfer. 15 cents on the dollar against the most acute physical demand environment in a decade does not resolve in the direction the paper sellers are betting on. Watch the 4 signals. Brent at $100 as the mining cost floor, Shanghai Premium at the Asian Open as the demand confirmation, PSLV discount at CFConnect.com as the institutional rotation signal, CME Vault report for 86 million moving toward 80 as the suffocation threshold. Verify everything. CME Group Vault reports are public and updated daily. OFAC Waiver documentation is on the U.S. Treasury website. PCE and GDP data is published by the Bureau of Economic Analysis. SHFE Vault figures are published by the exchange. Monetary Metals' lease rate offering is publicly stated on their platform. The data is public. The mechanics are understandable. When 15 cents of real metal is backing every dollar of paper claims, one of those 2 things is temporary, and it is not the metal. Invest with logic, not hype. Market Crux, signing off. Market Crux, all data independently verifiable, not financial advice.